This is a doodad example, and it is an example that's going to take us through a set of transactions, trial balances, adjusting entries, a trial balance, an unadjusted trial balance, adjusting entries, and then an adjusted trial balance, and then a multi-step income statement, and a classified balance sheet. And we're going to do this all in the next half hour or so. Let's get started. So part one, we're going to focus, and we're going to do this in two parts. The first part is going to take us through the original transactions, and then we're going to record those transactions, and then we're going to do a trial balance. Then we're going to stop. And part two is going to pick up after that and do adjusting entries, and then a new adjusted trial balance, a multi-step income statement, and a classified balance sheet. Okay, get started. Here's the information we're given. DD recently began the Doodad Corporation to sell doodads with the aim of making money. So it's a business. The following events occurred during the first quarter that began on 2 January. Number one, on 2 January, DD and her fellow shareholders contributed €600,000 for stock with a par value of $60,000. Number two, during the quarter, the company purchased €200,000 of inventory with cash. Number three, during the quarter, the company purchased €85,000 of inventory on account. That means we're going to pay later. Number four, on 26 January, €11,000 of the inventory purchased on account was deemed faulty, and we returned it, quote, for credit. That is, we don't have to pay. They reduced how much we owed them. Number five, on 2 February, Doodad Corporation purchased €36,000 of equipment by paying €10,000 of cash and signing a 12% 2-year balloon note payable. The equipment is not expected to be worth anything at the end of its 5-year estimated life. Number six, on 15 February, Doodad paid €16,000 for an insurance policy to cover the next 16 months. On 1 March, number seven, Doodad paid 2 years of rent in advance for $48,000. On number 8, during the quarter, Doodad paid $20,000 of the bills received for the inventory purchased in number 3 up above. They paid that $20,000. And finally, in number 9, during the quarter, we sold €65,000 worth of doodads for €30,000 of cash and $35,000, quote, on account. That is, our customers are going to pay us later. The doodads had cost the company €40,000. So these events need to be recorded in Doodad's General Journal and posted to the General Ledger, i.e. T accounts for class purposes. A trial balance needs to be prepared, and financial statements should also be prepared. Doodad incurs a 35% income tax on profit. Okay, let's start with transaction number 1. On the 2nd of January, DD and her fellow shareholders contributed €600,000 for stock with a par value of $60,000. So what we're going to do is think of this first in terms of the accounting equation, and then we'll put it into a journal entry. So the initial investment, from the standpoint of the company, it's getting $600,000 in cash, and cash is an asset. And so what we're doing is we're going to change the existing accounting equation, where we have assets on the left and liabilities and owner's equity on the right. We're going to change it by $600,000 And every time we do it, it affects two items. And the accounting equation remains equal after we get done. So we're changing something in this accounting equation. And that's why I have the little triangle. Triangle means delta or change. And we're going to change that because the company is now getting $600,000 of cash, and the owners now have $600,000 more of their share of the company. Their share has increased by $600,000. So we keep this accounting equation in check. Now we're going to put it in terms of debits and credits in the general journal. And the general journal is the book of original entry. It's the place that the transaction first hits the books. And we have that, we know that assets are increased, and the things on the left-hand side, the assets, are increased with debits. And the things on the right-hand side, the liabilities and owner's equity, well, they are increased with credits. And that's what we're going to see here, is that we're going to increase cash with a debit, and we're going to increase capital stock by $60,000. And this is the par value of the stock, the minimum amount that the company could sell the shares for. Now, they sold it for much more than the minimum amount, but the par value was $60,000. And that minimum amount was set by Dee Dee when she created the corporation with the state. Could be, wherever she incorporated that company. She had filed some paperwork with that state and said, this is my par value. She doesn't necessarily have to have a par value. A lot of states allow no par stock. But she did. And the par value of these shares was $60,000. And that tells a reader, people put in at least $60,000 because that's the par value, the minimum amount that those shares could be sold for. And indeed, they put in another $540,000 of additional capital. Sometimes we call it additional paid-in capital. And then we put in an explanation in English at the bottom. And that explanation is to help people who don't understand debits and credits to understand what went on in that transaction. Sometimes those people are, if the company goes broke and there's questions about claims to the assets, then the lawyers get involved, and the lawyers are not famous for knowing accounting. Some of them do, obviously, but most of them were not simply trained to be accountants. So that's transaction number one. All right, in transaction number one, we're going to have a T account for cash. And we're going to debit that for $600,000. And we'll call that number one. We'll have a credit to capital stock. And that's going to be for $60,000. And that's going to be also in number one. And a credit to, we'll put it down here, additional paid in capital. And that's going to be for $540,000. And that's in number one. And let's go ahead, and we're going to now take that and put it over there. We're going to, in transaction number two, it says during the quarter the company bought or purchased 200,000 euro of inventory for cash. So think of it first in terms of the accounting equation. We have inventory that's increased and cash that's decreased. So we start with, I like to do the cash part first. Cash is a decrease and inventory is increased. Notice that there's no change on the right-hand side of the accounting equation. just a change in the mix of the assets on the left-hand side. So when I said earlier that we increase assets with debits and we increase liabilities and owner's equity on the right-hand side with credits, the opposite is true if you're decreasing something. So if you increase an asset with a debit, you would decrease it with a credit. Likewise, if you want to increase a liability or owner's equity, you do that with a credit. But if you need to decrease those things, and we'll have transactions like that, you'll do that with a debit. So let's take a look at how this shows up in the general journal. We've got our debits and credits, and we are going to credit cash because cash is an asset and it's going out. I always like to do that cash part first, credit cash, and debit inventory to decrease cash and increase inventory, and then the explanation to buy inventory with cash.
In number 2 is where we bought inventory with cash for $200,000. So we're going to come here. Let's put it in the cash part first. Bring that up again, and that's going to be a credit to cash for $200,000. Number 2. Let's make that small again. And we have a debit to inventory and that's going to be a debit for $200,000 in number 2. Let's see if we can't make that small. Put it up over here.
In transaction number 3, it says during the quarter the company purchased $85,000 of inventory on account. So on account means that we're going to pay later for this inventory. So it's a liability. We buy the inventory, they deliver the inventory, and we owe them. So in terms of the accounting equation, we got the inventory, increase the inventory asset, and we're increasing the liability by $85,000. That liability is going to be called accounts payable. It's a specific type of a liability that relates to operating transactions, things like buying inventory, for example. The most common example of accounts payable is buying inventory. So we debit inventory to increase that asset, and we credit accounts payable, which is on the right-hand side, to increase the liability. And notice that the accounting equation remains in check. We've increased assets and we've increased liabilities. Now we just need to add that explanation in there to buy inventory on account.
And now in number 3, we're going to, during the quarter, the company purchased $85,000 of inventory on account. So now let's bring that inventory back down here. We buy inventory $85,000. Oops. A debit for $85,000 in number 3. And we're going to do that on account. We're going to create an account called accounts payable. And that's going to be a credit to offset that, and it's coming from that journal entry that we just did, $85,000 in number 3. Let's take that all and make it small and put it down here. Put it up there.
In number 4, it says on January 26th, 11,000 euro of inventory purchased on account earlier, actually in number 3, just above, is deemed faulty and returned for credit. That is, we don't have to pay for it. So thinking of that transaction in terms of the accounting equation, we're going to reduce the inventory because we're giving it back, and we're reducing how much we owe because they're giving us credit. They said, all right, you don't have to pay for that. That's what we mean in that sense of the word for credit. And it gets journalized like this. Think of the asset first. We have that asset going down. That's going to be a credit because it's either going up with debit on the left, or it's going down. It's going to be a credit. And we have the accounts payable, and that's going to be debited because we normally increase these things with credits, but we're decreasing it. It's going to be with a debit. And so we don't have to pay that accounts payable. It's already there. I mean, it's already, we've already gotten the credit for it. We've already reduced it. And when we say credit here, it's credit from the standpoint of the other company. We'll give you credit. Well, that's because they had a debit balance in their accounts receivable from you, and they're crediting their debit balance on their accounts receivable. That's why it's so confusing, because when they talk about credit on your bank statement, on your credit card statement, it's credit in a debit credit sense of the word, but it's credit on their books, not yours, which are, in some sense, a mirror. Yeah.
Okay, so now in number 4 is when we return the inventory that we bought on account. So, oops, I guess we need that again. We'll bring it up here. In number 4, we're returning the inventory. We have a debit to accounts payable for $11,000 in number 4, and a credit to inventory for $11,000. And so we're just posting the transaction we just did into these accounts. And these accounts we do in a classroom purpose in something called T accounts. But in practice, it's in a computer. The computer is doing this, and it keeps track of the debits and the credits, but it doesn't necessarily have a line down the middle.
Yeah. Okay, so that's number 4. In number 5, this is our first complex journal entry. On the 2nd of February, Doodad purchased $36,000 of equipment by paying $10,000 in cash and signing a 12% 2-year balloon note payable. The equipment is not expected to be worth anything at the end of its 5-year estimated useful life. So there's a lot of information in that. I think the one thing I want to talk about right now is, what do we mean by a balloon note payable? And actually, that's not a common, there's different variations of balloon note payable. In this one here, what we're doing is we're going to be paying interest because we're borrowing a bunch of money from somebody, and we're not going to pay interest or principal. Principal is the original amount that we borrowed, and the interest is how much we're paying to borrow it. Neither one of those things is going to be paid for 2 years. And at that point, so we're accumulating interest along the way, and then at the end of the 2 years, we pay it all off at once. That is, we pay the principal and the interest that's accumulated all at one time in 2 years. And it kind of pops. It's a balloon that gets bigger and bigger and bigger, and then it pops. Okay? So let's take a look at this. Buying the equipment. In terms of the accounting equation, was there any cash involved? Yeah, there was a decrease in cash of $10,000. And we took on some debt. We owe some more, and that's an increase in liability of $26,000. We also got this nice piece of equipment. It's an asset for $36,000. And if you think of the accounting equation on the left-hand side, well, we increased equipment by 36, decreased cash by 10, have a net increase in assets of 26,000, and on the right, a net increase in liabilities of 26,000. So all told, the accounting equation remains in check. Let's do this in terms of the journal entry and how it gets recorded in our books. That is, it's going to be a credit to the cash for $10,000 to reduce that cash. And we're also going to be increasing the equipment, a debit to equipment for $36,000, and a credit to notes payable to increase how much we owe. And of course, we're going to put an explanation down there in English to buy equipment with cash and a note. There you have transaction number 5. In number 6, on 15 February, Doodad paid €16,000 for an insurance policy to cover the next 16 months. So here, we're paying out $16,000 in cash. That's a decrease in the asset cash. But we now have this insurance policy that's going to reduce our risk for the next 16 months. And if you think of an asset as something we own, well, we paid for it, and we're the ones that are going to be protected, and it's going to give us a future benefit, well, that's going to be called prepaid insurance. So we're going to decrease our cash and increase our prepaid insurance. The right-hand side doesn't get affected. And we're going to put that in the journal entry like this, a credit to cash and a debit to prepaid insurance, $16,000. Changing the mix of the assets on the left-hand side. And we'll put it in the English at the bottom there to pay 16 months of insurance premium in advance.
The cash part is going to be a credit in here in the cash for $16,000. Number 6. And we'll make that small again and put it back up over there. We have a new T account called prepaid insurance. It's a debit for $16,000 in number 6. And we're going to take that and make it small. We'll put it over right in there.
In number 7, on the 1st of March, Doodad paid 2 years of rent in advance for €48,000. Very similar to number 6, we're paying for rent, and now we have the right to occupy this space for 2 years because we paid it all in advance. So in terms of the accounting equation, we're going to decrease cash, and we're going to increase this asset because we have the right, we own it, we paid for it, we're on the lease, we have the right to occupy that, and we have this asset called prepaid rent. Again, changing the mix on the left-hand side, not changing anything on the right-hand side. In the journal entry, again, a credit to cash because we're decreasing the cash, and a debit to prepaid rent. And there's our journal entry there.
We have a credit to cash for $48,000. Let's bring this down here. A credit to cash for $48,000 in number 7. Okay, so we'll try to make that small again by taking that down here, putting it up there. And that's a credit to cash for $48,000, and we're going to have a debit to prepaid rent. And that's going to be a debit for $48,000. And that's going to be number 7. And again, we're going to take that, and now we're going to make that small and let's put it in here. I'm going to keep all of those T accounts, but they don't need to be quite so big. We'll put that down there. I'm just keeping a record of those.
In number 8, it says, during the quarter, Doodad paid $20,000 of the bills received for the inventory purchased in number 3. Well, we owed these bills already. We had an account payable for that. So what we're going to be doing is we're going to reduce our cash by $20,000, and we're reducing our accounts payable by $20,000. Notice the change on both sides is a reduction of $20,000. And the journal entry, to reduce an asset, assets are increased with debits. To reduce it, it's going to be with a credit. And liabilities and owner's equity are increased with credits, but to reduce the liability, it's going to be with a debit. And so there's our journal entry, a debit to accounts payable and a credit to cash.
Now let's take a look at number 8. During the quarter, we paid $20,000 of the bills. So now what we're going to do is we're going to need this cash here, and let's bring that down here and make it bigger again. And we're paying $20,000 of 20,000 euro of bills, 20,000 in number 8. And we can now take that and make it small again. And we're going to debit how much we owe for the accounts payable. So let's make this bigger. We're going to decrease the accounts payable with a debit for $20,000. And that's going to be number 8. Make that small again. Put it up there.
Finally, in number 9, during the quarter, the company sold $65,000 of doodads for $30,000 cash. The remaining $35,000 of sales were, quote, on account. The doodads had cost the company $40,000. So let's do this in 2 parts. Part A is going to be recording the revenue, and Part B is going to record the expense. Let's do A, or Part 1. We're getting some cash, $30,000, and we're getting accounts receivable. And the accounts receivable is also an asset. So we get $65,000 of assets, some of it in cash and some of it in the right to collect cash. And we're increasing the owner's equity by $65,000 because the owner benefits from those sales, or what we call revenue. It's going to be recorded like this: a debit to cash to increase the asset cash, a debit to accounts receivable, and a credit to sales. Now, sales is revenue, and we have both revenue and expense that affect owner's equity but they're income statement accounts. They're temporary accounts that get closed out every accounting period. It's zeroed out down to zero, and we start over for the next accounting period. So we can do a new income statement. And so we have to record the sales of the inventory. Now, if we go back here to the question, it says the doodads had cost the company $40,000. Well, we had all of these doodads in our warehouse, and now we put them on the truck and delivered them. We don't have that asset, that inventory anymore. It is used up. So we need to record that part of it. And this is the matching part. So we recognize the revenue when it's earned, and we recognize the expense when it's used up. We try to relate that expense to the revenue in the period of the revenue. That's the matching notion. So record the cost of sales. In the accounting equation, we're decreasing our asset inventory by $40,000, and we're decreasing owner's equity because when the owner benefits, or the owners benefit when we record revenue, but they also have to pay the expense. They're the ones that are at risk out there. They're the owners. And so we have a decrease in the asset, and a decrease on the left-hand side, and a decrease in owner's equity on the right-hand side. That's going to be those opposite transactions. So inventory is going to be credited for $40,000. Remember, we increased assets with debits. Well, we're decreasing it. It's going to be with a credit. And cost of goods sold has the effect of decreasing owner's equity. It's an expense that owners pay, reducing the owner's share of the company. And we increase these things on the right with credits. We're going to do this with a debit, cost of goods sold. And let's put that in and into our journal entry and record. The explanation would say to record the cost of inventory that's been used up to produce the revenue. In other words, it's an expense, this cost of goods sold.
And now in number 9, it says that this is where we sold 65,000 of doodads for 30,000 of cash. So once again, let's do the 30,000 of cash. We'll bring this down here and make it big. A debit to cash for 30,000 in number 9. Make that small. Make it even smaller. Put it up there. And we're going to have a debit to accounts receivable. That's a new account. I'll abbreviate AR because that's the normal abbreviation. It's going to be for 35,000 in number 9. And we're also going to have a credit to sales. That's our revenue account that increases owner's equity. And that's going to be for both the debit for 35,000 in accounts receivable and the debit to cash for 30, or 65,000 credit in number 9. Make that small again. Well, not again, but we're going to make it small. Put it up over there. And then we're going to have the last part is the matching, where we say we have cost of goods sold. COGS is the abbreviation I'm going to use there. And we're going to debit that for 40,000. It's an expense that reduces owner's equity. It's also transaction number 9. We'll make that one small and put it up over here by the sales. And then we also have the inventory going out. And so let's bring it down and make that a little bit bigger. The inventory going out is a credit for that 40,000 in number 9. And there we have now posted all of these transactions. The next step is then to figure the balances of each one of them. Let's start with inventory, for example. We have 285 and we have 51 on the right. That's a 5. 285 minus 50 is 235, minus another 1 is 234. That's our balance there. Accounts payable, we have 31 on the left, 85 on the right. So 85 minus 30 would be 55, minus another one is 54,000. And this is how we figure the balances. And now we can take that and make it smaller again. In here, we're going to blow this up, the 35,000 balance. That's all that is, sales. We don't really need to do anything with things that just have one entry in them. Let's take these, make that a little bit bigger, make this a little bit bigger. So here we're going to start, and we're just going to put that double underline underneath the 40,000 for the cost of goods sold. Then I'm going to make that one smaller, if I can. I'll put that one up here. And over here, we'll put a double underline under the 36,000 and under the notes payable. We'll make that smaller. Put it up over here. Let's see. The cash is a big one, right? We have 630,000 on the left. Let's put that here. 210, 226, 234, 274, 294 on the right. If we subtracted 300,000 from 630, it would be 330, but we didn't. It's going to be 336 because there's 6,000 left over. So 336 is the balance. We have the capital stock. There's only one entry there, and the additional paid in capital. And now we can make that one small. And we'll take that up here. And then we have the last two, prepaid rent and prepaid insurance. Prepaid rent, we'll do that, make it small, put it up over here. And the prepaid insurance also, and make it small. And then that's all of our T accounts there. I don't know if we can how we can make that bigger. I think we might be able to do that here. There's all of our T accounts, and then from here we're going to make our our trial balance, which you know about already. It's coming up in the next slide.
So next we're going to take all of the balances that we have in the T accounts, and we're going to put them into the something called a trial balance. So a trial balance is an internal working paper. It still needs to have a heading, but it's still an internal working paper, and it says the name of the company, unadjusted trial balance, and the date. Well, this is the end of March. And we're going to list here all of the debits and all of the credits, the balances of all of the T accounts that we've done, and we're going to check to make sure that debits equal credits. So that's the end of the part one to the doodad example, and we're going to come back and we're going to do the adjusting entries, the multi-step income statement, and the classified balance sheet. That's coming right up.